Okay, welcome to my video on trading futures contracts. So this idea of the futures market has this concept of that's one market called the futures market. And that's where contracts are traded, bought and sold, out in the future. Now, there's another market called the cash market. That's local grain suppliers buying and selling grain. That's local cattle markets buying and selling the real cattle. You could actually even do contracts in this real cash market area, and that is done all the time. The futures market has developed itself into a second market. And in the very beginning, these two were one and the same, but now we have a definite distinction. There's lots of cash markets all over the globe, all over just even our counties and areas and states. So cash markets are a market that exists out in the price world. Well, these prices differ by location, but that's a cash price commodity or cash market. The futures market is kind of our focus, but it's a second market. So inside of the futures market, things are bought and sold as well, except there is no delivery. They're trading contracts. And so in this video, I wanted to go outline that specific example of trading contracts. Provide a little bit of example. There's more terms that get developed, but hopefully these will help introduce how we use the futures market, buyers and sellers, hedgers and speculators, and what their roles are and how does that work. Now the futures market plays an important role in this because if they don't do it right, it won't work. So the idea of trading futures contracts is the focus of this video. So take a look. Okay, so let's talk in this video about how contracts are traded in the futures market because that's kind of an important concept. And to do that, I want to go back to the 1800s. And so in the 1800s, you had a buyer one, a buyer two, a buyer three, a buyer four. You had these folks get in their wagons and drive over to basically the Chicago Board of Trade. So again, that's located in Chicago. And so these folks came there, and they came there with a certain reason, and that was to buy. Now, on this given day, and the markets organized themselves by times, you had sellers that showed up the same time. And so I had these sellers show up. Again, they all got in their wagons, and they hoofed their way to Chicago so that they could make a deal with the buyers. And these sellers made a deal to have a conversation about providing a commodity. Now, not right then, remember, the futures market, and so I'm talking about the futures market here in the 1800s. The futures market is where people were trading contracts. And so remember, we still had these contracts that they were traded. They didn't want the need to buy or sell the commodity right then, like on that day. They came together to make an arrangement for the future, and that's what's called a contract, and we call those, of course, futures contract. Another term that sometimes was used, remember you had it a while ago, was a forward contract. But the deal was that these sellers were willing to bring that commodity, and these buyers would, of course, make a deal where they would swap them some money, and that was the idea of the futures contract. Now, who was in the room? So these buyers and these sellers, they could be described, and they were really described based on their need. So I'll tell you the first one. The first one was a hedger. Now the hedger was one that came to the market and they had a need for the commodity. So we describe them as this need. They had a need for the commodity. That was either to sell it or to buy it, either one. So that's called a hedger. They show up in the futures market in the 1800s, the same deal. Hey, I run a feed mill and I have feed that I need to deal with. So I need to make sure I have corn to get that done. So they show up to the market as a hedger to get that corn. They need the commodity. Same thing for the sellers. They have the commodity. They just need to make a deal to sell it. Again, not that day, but in the future. All right. Who else was in the room? Now, more and more of these people started showing up, and they are called a speculator. So why are they there? Well, they're there just to make money. That's the only reason why they're there. And how do you make money? Well, it's a simple business. What you need to do is buy what? Low. And then eventually you need to what? Sell high. And so when I say eventually, meaning that you could buy it one day and show up the next day And if the prices shoot up, you could turn around and sell it right then. What could you also do as a speculator? Well, you could sell high, and then of course later on you would have to do what? You'd have to buy low. So the idea of the speculator is they show up in the marketplace and they just try to make a buy on a day that's good, and eventually they try to make a sell. Now they have to get all of this done. They have to get it all done before the contract was going to be due. So that's very important. So these hedgers, they made a deal for a contract, and they stuck with that deal, and they provided the commodity, and they got the money in exchange for that. But then these speculators started to come in and started to kind of help the market work, because if you have this imbalance all the time, then the market would never really maybe correct itself, because there's not enough of these sellers, for example. So the speculators are important because they come in and try to help balance this out. And if they see something imbalanced, they have a duty, not a duty I should say, but they'll make money by buying low and then selling high later, the next day or the next week or the next month, as long as they get that done on a contract that is going to get traded before it becomes due. So what does the market look like today? Well, it actually looks just the same. So the market today, the futures market, is the same kind of arrangement. And I'm going to go ahead and write it in, but now it's called the CME group. And so you've got the CME. You've got people that are buyers, and there are not just a handful of them, there are billions. And then you've got people that are sellers, and they come to the market as well, and they are trading what we call a contract for the future. In other words, a futures contract. And so this contract for the future, or in other words, they're trading futures contracts, and these futures contracts are what they're making deals on. And remember, a buyer and a seller are both going to make a deal on this, and they are still two participants. They are hedgers and there are speculators, and the market allows for both of them to come into play. Now, here's what the market's going to make sure. The CME group's going to make sure something. They're going to make sure that the numbers of buyers, by the time the contract is done, equals the number of sellers. They're going to make sure that holds true every time. And when that holds true, before the due date, they will be able to have the exact numbers of buyers and sellers to equal, and that's the function of the market. Now, this is a confusing concept, so let me try to provide an example of how this would work. I'm going to have a couple of people here in my example. I'm going to have Sally, and so I need to get Sally in here, right? So I'm going to have Sally, and Sally is going to be in the market, and she is a cattle seller. So Sally is a cattle seller, and I'm going to have Billy over here that is going to be a cattle buyer for whatever his work involves. All right, so the two of them are in this situation together, and they come to the market. They may know each other, they may not. I'm going to say they don't know each other at all, and they're going to come to the market, and they are going to look at the price. And so Sally's going to see the price today, and the price today is, let's just say it's $120 per hundredweight or cut weight CWT. And so if we look at a market today and we say, well, $120 a hundred is the market. Billy looks at this market and says, man, I really don't think I want to buy that at all. So Billy sits there and does nothing. So Billy just waits, right? So he's waiting probably for one reason is that he thinks the price is too high. So if we didn't have somebody else to come to the table here, we would kind of be in a bind here. So what happens is there is a new person that comes in the market. Let's say Ted. And Ted comes to the market, and I'm going to say that Ted is a speculator. So Ted really doesn't have a need for the cattle, but Ted comes to this market, and he looks at this price, and he goes ahead and says, you know what, I think I would come in here and I would go ahead and take a position on this, and their position, his would be a buy. So Ted has a buy at $120 per hundredweight, and he's going to have that bid today. So that's where he starts out. Now over time, let's just say 1 month later, so plus 1 month, when we look at the market, let's say that for Ted, the market has gone to $125 a hundredweight of a price. And so now Ted looks at this and says, you know what, I'm going to sell my contract. And so if Ted buys a contract of cattle and then turns around and sells that contract to someone else, because these two equal, he is what we call out of a contract. So he doesn't have to be involved at all. So he's out. He actually looks at this, and here's what happened. He made, it looks like $5 per hundredweight profit because he took that position. So really, if we didn't have speculators coming into the market and it was just a seller and a buyer of cattle, these two are examples, by the way, of what person? They would be examples of hedgers. So if we didn't have speculator to come into the market, then this would not work. Well, now Sally, she wasn't really the one that did this. Ted came in through the futures market and made this whole transaction happen. So Sally still got cattle. Billy still needs to buy cattle. These two participants will be involved in a second market. Remember, we talked about it before. That second market is going to be that they will go to the number 2 market, which is the cash market, and they will really get their commodity sold or bought either way. But the futures market offers a number 1 place, to actually trade. So there's really 2 prices. One's the futures and one's the cash. And the futures market is going to make sure every time that the numbers of buyers and sellers match. Now, how could Sally get involved in this market? She would do just like what Ted did. Ted would be involved in the futures market and she would take a position on a contract, which we will get to because those are called hedgers. Now, these hedgers have certain contract positions they take, and it's based on who they are. But I wanted to kind of try to bring in the concept or an example. And so what is the futures market's role in trading? The futures market's role? The futures market's role is to do a lot of things. Their role is to educate people and try to get buyers and sellers involved. The more buyers and sellers they can get in the market, the more true picture we get of price. But they have one major role, and that's that the number of buyers will always equal the number of sellers. And they will make sure that this happens every time. Because that way, all the contracts, so there could be an example, there could be 1 million of these buyers coming in. They will make sure there is 1 million sellers of those contracts. And so nothing is going to get delivered to Chicago Mercantile Exchange. They make sure of that. Now remember, back in the late 1800s, let me back up, it was very important for these people to know each other. They had to know each other. That was how that got traded. It didn't get traded right then today. Remember, it always was traded in the future. However, as we move through time, these hedgers and speculators got to be more defined, and then it got to become very relevant that if we were really going to get a good picture of price, we needed a whole bunch of buyers and sellers. And so this market developed. Now, why do we need a whole bunch of buyers and sellers? Because it really creates a better picture of price. But the market now has there's two markets. One is the futures market and one is this cash market.